So anybody looking at a price chart would say, oh boy, look, it's a breakout. Okay. That was it. Tombstone was placed right there. And then the bear market started. I mean, it really didn't unfold hard till later 2008. But again, complex top, meaning laborious, new high involved. But momentum says, it's not valid. It's a trap. We're in that same position now.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Michael Oliver again. Michael Oliver runs Momentum Structural Analysis. You can find his service and work at olivermsa.com. Michael, welcome back.
Good to be back, Mario.
Yeah, I'd been thinking about you because the stock market seems to just keep squeezing higher. I made a video the other day talking about the Nasdaq 100 that it made an all-time high, and that there is a possibility of a melt up. And then yesterday, the S&P 500 made an all-time high. The Dow Industrial still not at all-time highs. And I thought it would be great to have you on because you don't just look at prices, you look at
Uh,
momentum. So maybe you can tell us if this is like a false breakout or if it's for real or if we're seeing maybe a currency event. And then we can also look at the dollar index after
Yeah,
that.
absolutely. Yeah, it's important now. As far as the stock market, I'm having deja vu. Okay. MSA's been around since 1992, servicing institutional clients, major fund managers, and so forth. And then we opened to retail market in 2015, I think it was. But we look at all four asset categories, and the stock market is really important now, we think, because usually, when the stock market breaks, that's when you get the data points to go south. In other words, all the Powell's sitting back saying, "Well, everything looks good, et cetera, et cetera." Well, it's hardly ever the case when the stock market peaks and heads into a major bear that the data points warned you ahead of time in any big way. Those usually come, a handful of months after the high, then suddenly all hell breaks loose. Okay. Now, technically speaking, though, let's get to what we do. Yes, we look at price, but it's secondary to us. We've long learned that price is often delusional, particularly at trend change times. Whether you're making bottoms or tops, quite often it's confusing to the guy who's looking at the price chart because the price chart looks either, oh, it's still weak, or oh, it looks like it's going up forever. Momentum will tend to almost always break its prior trend prior to price breaking a similar prior trend. Whereas you look at the price chart, you don't see the breakage. Look at the momentum chart, say, oh, it broke. Okay. What happened in January on the S&P, barely coming off of its late 2024 high, it broke enough quarterly momentum trend structures in our work. Now, what does that mean, quarterly momentum? That's when we measure price in its relationship to a three-quarter average, which is a fairly long-term average. And it doesn't matter whether you're above or below the average necessarily. It's the structures that you build visually. When you look at the momentum chart, you see like what you see on a price chart, except usually price doesn't show it at that time. We broke major structure and we paid dues into April. The event started to unfold about a couple of months after our breakage point. We've now come back, and I've been hoping personally, and I've even mentioned it in the reports, that don't be surprised by a new high. It's highly, highly likely to be false, deceptive, and a trap. Okay. Now, when we go back, I said deja vu. Back in 2000, we had the dot-com top. At that point in time, in January, in fact, the first day of the year, we put out a report saying, get out, it's over. Okay. And we had a sharp break right after that. It dropped into like February, dropped like 10% or so. It was a pretty sharp break then. And by March, it came back up and made a marginal new high by a handful of percentage points. And so everybody thought, well, boy, is he wrong? We said, no, the structure was broken on momentum. Price is making a new high, but it's a trap. And it fiddled around up there, either side of our January sell point. Again, this is the dot-com top. And in August, it finally went up and made a new high monthly close as well, not just an intra-month high. Still not very far from the January sell point, but holding. So naturally, anybody who's long, their fears abated. Why? Because every time it tried to go down, it wouldn't go down. And therefore, oh, this is great, And then later in the year, it sagged off again. So by the end of the year, you're actually headed down a bit. And in January of 2001, the Fed would cut rates twice. They had been on a hold pattern for over a year. I think, no, for a year. And then they started cutting rates twice in the same month. And you were already somewhat off the high at that point. And it's only then that the real bear market started to show itself in early 2001. And of course, it dropped 50%. NASDAQ 100 dropped 82%. Okay, huge bear. Okay, again, confusing and laborious high. Go back to 2007 now. If you've ever seen the movie Big Short, it deals with three or four guys, analysts who were sort of outside the mainstream of Wall Street, who perceived, analyzed, and said, there's a problem here. It's a crisis. This mortgage situation is going to blow up. Nobody believed them. They were laughed at. It was a great movie in that regard. It was a true movie too. Um, they must have been pounding their heads into the wall because they assessed the market in 2005, 2006, 2007 is it's no good. Okay. And it took till 2008 before they finally got, they were vindicated. But that's a laborious top. You made a high in May of 2007 at around 1550 plus a few points over 1550 on the S&P. By the way, the old 2000.com high for S&P was also 1550. Okay. We went up and basically they sold that high. You had a sharp drop into August. In other words, anybody who was looking for a top got a sharp drop. And then suddenly in August, it turns up. September, mid-September, the Fed cut rates in an ambush way. Nobody expected it. Half a point. About 3 weeks later, it pushed up into October and took out the May high. So what do you get? May, June, July, August, Sept, a 5 month span there. And which also took out the 2000 year price high. So on a price chart basis, you've got to be pounding the table. It got to 1575. 25 points or about 1% above those dual highs. So anybody looking at a price chart would say, oh boy, look, it's a breakout. Okay. That was it. Tombstone was placed right there. And then the bear market started. I mean, it really didn't unfold hard till later 2008. But again, complex top, meaning laborious, new high involved. But momentum says, it's not valid. It's a trap. We're in that same position now in our assessment. When the market broke, gave us our signal in January for the S&P and early March for the NASDAQ. We had the sharp drop, but we had in MSA, we put out a report warning there's going to be a bounce point. And we defined it as 4,800 for the S&P and 16,500 for the NASDAQ 100. That's where they stopped within decimals either side of those numbers and rallied. And over the last, 2 months, it's been an inching type rally where it's not been explosive. It's just been creepy crawly. And now over the last 48 hours, S&P and NASDAQ made new highs. So everybody's saying, oh boy, it's on CNBC, Fox Business. So everything's okay again, right? No, we argue, no, this is a trap, price trap. Momentum says you broke your shin bone and your hip bone in that recent break. And the next time you turn down, you're going to break your backbone. Do not trust this rally. Why is it significant? If we're topping, and we are, money will flow elsewhere. It always does. In the past, whenever you look at the S&P enter a bear market, if you look over at T-bonds, oh, it's a place to be. It actually goes up. Yields go down. Gold also. Those two are the alternatives. This time around, it isn't. It's only gold. T-bonds are stuck in a mire, not far from the high end of their rates or the low end of their price action. So when the money flows, when you roll over again in the stock market, And I think we will, and I think you'll see the evidence of that probably early in this new quarter. Okay. When you start to see that rollover, watch the money flow because I'm going to bet that it gooses gold and the monetary metals in a more exaggerated upside manner, more vertical rather than arm wrestling. And you'd mentioned another thing, dollar index. You want me to get into that? Okay.
Yeah, yeah, definitely. And it seems like very similar then to what you were talking about in 2007 and 8, because we even in '08, I hadn't realized we broke the all-time high like from 2000, and we're doing the same thing now. And yeah, the dollar index, I don't look at momentum. I do when I get my research from you, but I look at charts a lot, and I've got this monthly chart from like '08 till now, and there's a like a upward channel, and
Hmm.
we're just testing the lower bound of that trend line or that channel. It's at 97.50, and it doesn't look good if we close the month below that level. Is that
Yes.
the
Mhm.
same thing you're seeing
Yeah.
for momentum? And
Yeah. If in
how would that
Yeah,
affect also treasuries, you
everything.
think?
Well, I mean, you got four major asset categories. You got government, you got debt markets, okay? You got stock markets, you got the commodity category, also with the monetary metals component of that, and you have Forex. But if you look at a dollar index chart, like your monthly, for example, and you go back, it made a high in 2022 and dropped sharply into late 2022, early 2023. It got down to 100 level. Oh, you pop it, yeah. You can see that surge there to 115 that occurred, yeah, that second yeah, peak over there. You had this sharp drop into early 2023, then a bounce, then a rally, then a bounce, just stuck in a mire, about a 7% range for 2 years plus. Okay. You tried to break out upside, and we warned that when you broke out above that little range there, you nipped above it for a month or two. We said that's a trap, don't believe it. Okay. Sure enough, in March, which is this first big red candle you got there, the biggest of the two, yeah, there's two big red candles. The first one is March. It closed that month at 104.21, right in the middle of the price ink. Okay, so it didn't break through the lows, but annual momentum blew a comparable channel to the one you see on price. It did it at 104 area. Since then, price went down, took out all those lows around 100, and got down to 97 yesterday and today, intraday. When we turn to an even longer term annual momentum chart using a 10-year moving average of the dollar, plotting the oscillator looking for trend structures, not just crossing above or below that average. It is breaking a trend structure that goes back to the 1970s. Okay. So it is a huge, ugly trend channel. And therefore, momentum is saying, yeah, you've now dropped to the bottom of your price channel. Probably that price channel is not going to hold because already the momentum, 3-year average momentum, 10-year average, are breaking their structures. And what we need to complete the 10-year average momentum breakage is to close any month this year below 98.35. Right now, you got one day left in the month, and we're trading 97.10 as we speak. Okay? So you got a problem.
Is that the future? Because
I'll use the cash only, cash
yeah,
index.
because I've got here 97.35. I'm not sure if this is a
That could be cash. It may have just
yeah,
bounced some.
yeah.
Yeah. But it's
So
still, it's
I
well below that number. Yeah.
we'd need a big rally for the dollar on
And
Monday.
yeah, on Monday, yeah, right. If you close below 98.35, credibly, let's say, and you're credibly below it now, yeah, you're on the price channel. And you'll notice for the last few months as you approach that channel, there have been buyers thinking, oh, I'm going to buy channel bottom and make some money. Well, they've been buying it. You got down to under 98 2 months ago in April. May had a mild nothing bounce. Then this month is down again, new lows, 97, and you're squarely on that channel, which is a valid price channel, by the way. I think it's a valid technical feature, but it's lagged to its own momentum. Its own momentum says, no, you're broken. The other way I'd look at that rather than drawing that downtrend, see the collapse from the upper left to that 1982, 1991, 92 level? That's a first major leg. Then you have a second major leg, and I bet you're about to have a third major leg. And it wouldn't shock me that the lows you see there are coming out in the
Oh,
next year.
the
Yeah, in the
low,
70s. Yeah,
yeah.
in the 70s.
So
Now
you
remember, this is not a real valuation of the dollar.
no, it's just against the
Yeah,
euro
it's
and
other
some other.
fiat junk, so
Yeah,
the euro and the yen constitute 70% of the dollar
yeah.
index.
It's
So
not.
it's measuring, skata versus skata, okay?
Yeah,
Anyway,
should I bring up gold? Do you wanna?
if you want, yeah. And
Yeah,
another point there is that if you go back on that dollar chart, you'll see that it had a surge high that got up to 100 back in late 2015 when gold made its low in December of 2015. You see that surge there, right there, yeah, right about there.
yeah.
No, wait, yeah, that surge. You closed in December of that year when gold was making its low at 1,050.
I
The
remember that. Yeah,
dollar index was in the area of 98. Okay, where are you now? In that same area. So
yeah,
in other words, if you're looking at the dollar as your sole metric to judge gold, you're wrong because
yeah.
gold has doubled and almost tripled. Yeah, well, no, it's tripled um,
Well, the low in
since 2000. Yet the dollar's not moved.
the low in 2008 was 70.69, and
Yeah,
gold is
and
at
when
1,030, and now gold is at 3,300.
yeah, and when gold made its low, which is in the middle of that chart, when you surged up to
Yeah,
the your level, right there, yeah, that's when gold made its bear low.
yeah,
And since then, the dollar has oscillated to the side of that price, and gold has yet trended up sharply. So, using the dollar as your primary
yeah,
judgment method of gold is totally wrong. I think the breakage here in the dollar that we're going to get is a couple things. One, it will provide more wind for gold. It's not a primary driver, but it will help. But the other thing is, it was the quiet one during 2023 and 2024. It was in an 8% range. There was volatility in other markets, but the dollar was dead. There was no volatility, no waves impacting anything. Euro, yen, it was just all muck. Now suddenly the quiet one, I think, is waking up, or rather down, and that will create wave effects in other markets.
yeah. I
In
guess
particular,
when we
yeah.
saw this big move down in the dollar index from the beginning of the century,
Well,
that's
that's
when
when the
the
stock
stock
market
market.
peaked. The stock
Yeah,
market peaked
yeah,
in
yeah.
2000.
I
Yeah.
put these two arrows here because the other day I made a video. I said make or break,
Yeah.
make or break. But what would you say is the probability that we break
I
down?
have to rank the green arrow as highly, highly, highly unlikely.
Okay, great.
I mean, I think the red arrow is the shock impact because it's been
Okay.
so dull. And again, if you let's say you're a European investor in a US stock market, and we know that over the last few years there have been more investors, foreign investors in US stocks than ever before. Somebody's measured that. Okay, I've heard it many times. If all of a sudden, not only does the stock market start to wobble and create doubt in terms of its price level versus the dollar, but if you took your yen or your euros and converted them to dollars and bought stocks, you're getting gut kicked by the dollar. If it suddenly drops, it's already dropped from late last year, 110 down to 97. So, that's a factor for you as to whether you're going to hold on to US government bonds or US stocks. Uh, and that could have a wave effect in that regard.
Okay, great. Could we move to silver now?
Yeah.
Because you were a futures and options broker, and so was I. But I don't really follow too much the commitment of traders and open interest anymore.
Nor do I. Nor do I.
A lot of people do. I mean,
Mhm.
ultimately, I think those futures markets for the precious metals will be defunct. But right now, the talk is that the bullion banks have record shorts in silver, despite the fact that silver has just broken 35 recently. And today, as we speak on Friday, silver was hammered all the way down to 35.77, but now we're at 36.14, and gold as well was hammered, but we'll stick to silver. So,
Mhm.
where do you see silver, and what levels have you got, like in terms of momentum for further gains?
I think we've entered it for silver. As you noted, there were two highs at 35. One was last October and the other one was March, just prior to that puke drop we had when we dropped 27.50 in early April, trying to act like, oh, I'm part of the stock market. Okay, which it isn't. Okay. Gold, meanwhile, during that drop, had a single percent drop. Silver had a $7.5 drop. Most of that in 2.5 days, by the way. That cleansed the market, and you came back up. And when we got above 34 recently, we had yeah, these are monthly bars here. Yeah, you can see the dual highs at 35 there. That shelf there. Yeah, and we got above that early in this month and we defined about 34.90 as a breakout that would blow through the 35 level and get a triple top breakout, meaning you hit 35, back off, hit 35, and you hit 36, it's a triple top breakout, right? Okay. So the price guys sort of woke up then. And for the last 4 weeks, it's been dull, dead, and firm, closing the weeks out basically at 36 or higher. For like, see, look at that. I mean, they're selling it, but it ain't going down. Okay. It's just sitting there taking it. And during this time, of course, the stock market's going up over the last 4 weeks. Silver hasn't. Who cares about silver anymore? We got the stock market. Okay. Uh, I think silver is about to launch in a way that will drop jaws. I don't think this launch is the end of the bull market. I think it's just an acceleration phase. My assessment, and this is technical, is that this acceleration phase is likely to blow through 50 very easily and maybe pause between 60 and 70. And that occurs in the next, within 2 quarters, probably even less time than that. So, but between now and the end of the year, I think during that time, gold will also go up, but it won't go up as much as silver on a percent basis. I think I sent you a chart in that regard.
Yeah, yeah, I've got it here.
It
So
says a lot. This chart really
let's
does say
yeah,
a lot.
let's get this chart up. This one?
It's not sophisticated. It's not momentum. All it is every single year, those graph bars show what is the highest reading of silver, divide an ounce into an ounce of gold, express it as a percent. And you can see there's a red line going through 21 of those 50 some odd years where it's at least 2%
Yeah.
silver price divided into gold. And in bull trends, like in 79 and 80, when it went up to 6.5, or in 2011, when it went up over 3, it goes even higher than the 2%. Right now, we're just above 1.1. We're not at the high of that. That just shows through 2024. But we're moving up toward the upper end of those last three graph bars you see there, which are in the low 1% level. Okay. We analyze this on a closer up basis, and we argue that when you close a month out above 1.1%, right now we're toying with that number right now. Divide silver into gold, express it as a percent. Okay. Um, we're using right now July silver there in this month. We'll rotate to SEP next month and August gold. Okay. Right now they're trading maybe even better today. I'm not sure. 1.1% area. You close a month out over that, and I think we're going to start a move that takes us up to that 2% level. And you say, well, big deal. Well, if you bought a stock at $1.10 and it went to 2, you've almost doubled your money. And what this chart tells you is if we go back to a normal 2% level, it's not even, it's not rare at all.
Yeah,
Uh,
that's $60 silver.
yeah, I mean
Gold's at
that, yeah,
3,000.
yeah, yeah. Yeah, gold go up another $1,000 and silver will be 60, 70, and if gold goes higher, which I think it will ultimately. But right now, my focus in my own portfolio, and we reveal this at the end of all our reports, we show what we own, is emphasis in silver and silver miners. I think that's the better place to be in the monetary metals category. It has not been the best place to be for the last couple of years because silver has, while it's gone up in price, it is underperformed on a percent basis the gains gold has produced. I think that's going to switch very quickly.
Uh, Talking about miners, what about the gold to gold mining percentage
Yeah,
ratio chart?
yeah, yeah.
Which mining index are you looking at?
Well, we look at XAU for history because it goes back to the
XAU, yeah.
1980s, and it's silver and gold miners, by the way.
Yeah.
Philadelphia Gold and
Is
Silver
that the
Miners.
HUY? Is that the one or
XAU,
oh, it's
no,
different? Yeah,
XAU, yeah.
it's the Philadelphia one. Yeah.
And then we look at GDX, which is the popular gold mining ETF, which also contains about a half dozen big silver miners. We think that relationship, which has also been underperforming gold over the last since mid 2020, basically, or 2021, the miners have gone up nicely, but they've not gone up as much on a percent basis as gold has. That spread is starting to break out, meaning if you looked only at the month to month closing relationship of GDX price to gold price, you would see a structure, a trend structure, and it's breaking through that. It tells me that coincident with the silver shifting to outperform, you're going to have the miners shift to outperform. So yeah, gold is the mama, but it's not going to lead from this point forward. I think silver and the miners will now lead.
I've got a chart here. It's the XAU divided by the gold price. Is that
Yeah.
the one?
Yeah, that's
Yeah.
that's I've sent that chart out many times. Yeah.
Yeah.
Look back in the 1980s there. You'll see that it lived in a range with lows at 17.5% and highs up in the mid 30s%. In other words, you divide XAU price into an ounce of gold, and it was 17.5 to 35% range, lived there for 2 decades. It was normal, in other words. But when the bear market started, well, in 2008 for this spread, especially once the bear started in 2011 and 12, in net price, I'm talking, the spread collapsed. Okay, now I mean, they're not going to go to zero. Okay, miners aren't going to go to zero in relation to gold. They went down to like 3% something in a spike, and that occurred coincident with when gold and the miners themselves made their little price lows in
Yeah.
that market.
That's when
Okay.
I started this channel, actually.
Oh,
No,
really? Okay.
end of 2015. So
Um,
anyway,
we turned annual momentum long-term bullish on gold in February of 2016. So 2 months off that low, that spread low, the spread started to turn up. Not just the price of gold and the miners, but the performance of the miners shot up from that exhaustive low reading. And they've lived in a range now, and we're in the middle of it right now. Okay. Now, but if you'll just look at the action since that 2022 high or 2021 high, that top of the range thing, it's been a downward zigzag. Okay. So we can plot that. There's a similar pattern on GDX versus gold. This is XAU versus gold. Same story. You've pulled back into the middle of the relative performance range that's prevailed for a decade. And you're starting to uptick now. The last few months, you see those green candles are coming up out of here, not just in price of these indexes, but in the relative performance to gold. Now, you're already crossing a line there, but when we run momentum of this, we're seeing even a more obvious breakout. But what we're arguing now is that this upturn you're seeing is highly likely to quickly get you to the top of that range, the past 10 years, meaning up around 8 to 9% zone. If you ever clear that, and we think you will, where is resistance? Well, take it up to the 17. Yeah, there you go.
yeah,
17 and a half. Look how pivotal that is.
I know.
So
And
you,
this,
you,
I mean, this is also here. This, if you,
yeah, that top of the range, you take that out, you go to the bottom of the prior range.
and if
That is a tripling of the
oh, you
recent
break
valuation.
nine, yeah, you break nine, you up to
Yeah, yeah.
18 very
But you're
quickly.
breaking out right now, as far as we're concerned, and that's a secondary breakout to take out the
Okay.
spread high. But the point being that you come up out of this hole and up out of this, what effectively has been a par performance base for a decade, because you've been going sideways in performance to gold, oscillating. You could easily go up to that next obvious resistance, 17 and a half, not even challenge the old highs. Just go there. That's a tripling in the relative value of miners versus where they've been for the last couple of years. Either side of 5, 6, 7%,
Yeah.
17 and a half.
Is that
So we think,
both silver
okay,
and gold miners?
yes, yeah. And my emphasis is silver miners for the
Yeah.
same reasons I explained. Yeah, the gold miners are going to beat gold, but the silver miners, I think, are going to come slingshotting out of here
Yeah.
on the coattails of silver in a way that causes jaws to drop. Okay.
Yeah.
Uh, so that's where I am personally. I'm an emphasis silver and silver miners.
Yeah. And well, so yeah, that was great. And to sum up, I guess the stock market, it's a laborious top, and
Yep.
don't be fooled by the nominal breakouts. The momentum's still very weak, right? And
Oh, momentum is very weak. In fact, what we've done, we normally look at longer term metrics like monthly momentum, quarterly momentum to assess a long-term trend change. Okay. You don't look at stuff like weekly momentum, week to week action. But when we do turn to that shorter term metric, we see a trend structure that's been built over the last several months that is so set for a downside break, meaning when you look at the momentum chart, you can see a floor. Price has been inching up, but momentum has built this floor at a 3 week average. A silly average, but that's where it's been stopping. They've been buying it there for like a month. Now you're zooming up off that support. Okay. So the weekly momentum is looking happy. It's not near its highs, by the way. Price is, weekly momentum is just up. You ever slip back below that average and you're going to start to puke. And that's going to surprise people because if you go make a new high, as we've done, and a week or two later, suddenly you're, oops, back below the old high, they're going to wonder, well, hey, this rocket didn't lift off. Uh, and I suspect that's what we're going to see. And I think, by the way, that's likely to be highly coincident with one, a more obvious break in the dollar, two, silver and the miners starting to produce like silver suddenly going up $3 or $4 real quick. I think a lot of these things could snap basically around the same time. And I suspect we'll see that in the early part of this new quarter.
and so do you think we're not looking at fundamentals, but it could be interesting. There's talk now that two Fed governors said we could cut at the end of July. And
Hmm.
in the past, when the Fed cuts, you've spoken today, a lot of times the stock market tops. Do you think that
It does, yes.
could be
Yeah.
a trigger?
I don't know a trigger. It's just an announcement by them that something
Yeah,
is wrong. In other
yeah,
words, when they finally
yeah,
admit, and they know these data points they're looking at are
yeah,
fumbly type numbers because they adjust them so dramatically. A
yeah,
month after they give a number, they suddenly change it by 40% or something. Uh, and it's becoming obvious, I think, to many people that there's a political rivalry here. There's Trump on one side wanting to print, 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 and lower cost of money, and Powell playing the inflation fighter. But if he gets like one more governor to speak up and makes it three, then suddenly he's starting to look like, somebody's doubting his judgment, even on the Fed. They need some data points you know. And if I suspect if he gets one good gut punch data point, like unemployment coming up next week, something like that, anything can give him an excuse, they'll do it. But any time in the past when the Fed has finally gone from a lengthy pause period to a rate cut, you can circle the price chart. And it was really historically an opportune time and place to be short. So
yeah.
it's an admission that something's wrong, guys.
Yeah. And do you think bonds are gonna be a safe haven like gold?
No, no.
So they're not they I mean they've rallied a little bit recently,
Yeah, they're,
but
they're anemic. Yeah.
momentum still.
No, we thought they had a good chance a handful of months ago of rallying up and taking out the price highs on the 30-year bond. Do you have a chart of the 30-year bond
Yeah,
futures?
I'm gonna bring it up.
Yeah,
Hold on a
good.
second.
I can a
Uh,
lot to see there just on price.
yeah, just give me a second.
And go back to 2000 if you can.
T-bond future.
Monthly would be fine.
Yeah, hold on. Month. Here we go. There we go.
Oh, great. Okay. Back at that spike in 2000, you got up to 200 area, but when it dropped off that in October of
2020, yeah.
2020, excuse me, not
Yeah.
2000. Yeah. In October of 2020, it dropped down into the 170s and we got long-term bearish at that point. That would be like a couple of months off the high. Okay. October of 2020. Yeah, just a couple of months off the high. In mid 170s is where we got bearish. So that candle you see that spiked down, we got bearish then. Okay. The market rolled over and then really fell apart though in 2022, meaning the yields exploded, price collapsed. And even a price trend line at that point came out in early 2022. You could, any idiot could draw a line and see it. But we got bearish in the 170s. Well, what you have here since late 2022 looks like a basing process, just looking at price. In other words, it goes down, but it doesn't really go down. Then it goes back up and then it goes down. And then we thought that last rally you just saw there that peaked 2 months ago in April, we thought that rally had a chance of taking out those two prior highs in the mid 120s. Yeah, that line right there, and really turning heads. Oh boy, bonds look good. We didn't trust it, but we thought at least could do that. You went up to 122 in that rally in April, and within 2.5 days, you collapsed to 111. That's a crash. Okay. When T-bonds move that big, that fast. Since then, you've been caught in the lower half of that collapsing bar's range, and you've reached down into the mid 110s. You ever close a month out down around 110 and a half, back down, if you slump off on this current rally, which is 115, no big deal. But if you happen to slump off again and get back down toward 111, 110, watch out, you could get a sharp panic in the bond market. And this is a fundamental that prior, like in 2008 and 9, it wasn't such a factor. We had mortgage problem. Okay, now you get a government debt problem.
Yeah. This
And
looks
it
like
is,
a, sorry to interrupt you.
go ahead, no,
It
go ahead.
also looks like a bear flag, like you got the flagpole and then
God
the
forbid.
flag.
I don't think you could go that low, but
No.
anyway. But the point being, if you just slump through that bottom of that range, the
Yeah,
central bank's going to go berserk.
and go
And
down to
the issue for the monetary metals is the degradation of the money unit by increasing the money supply, by producing cost of money factor interest rate arbitrarily below what a market price might be, and distorting the real value of your money unit over time. And accelerating it during periods of panic because they go berserk. They print, print, print. If this market doesn't behave, it doesn't matter what the data points on the stock market say. They get a problem here that it's a time bomb. And guys like Jamie Dimon, fundamentally speaking, think this time bomb is actually going to have a problem this time. It's not going to be abated.
yeah,
It's
and this chart here, I guess, is the opposite of the yield. A lot of times
yeah,
we
yeah,
look at the yield and we
yeah,
had 40 years of a bull market as
yeah,
and now it seems like we're in a bear market. I mean,
yeah. I thought we could get a bear rally that would try to get back up the underside of that line again, but no,
yeah,
it failed. It failed miserably.
yeah. I mean, there's
And
still a lot of people out there who think that uh, bond yields, long-term bond yields, could go to 2 or 1%. I can't see that happening.
no, the charts don't look right. Momentum doesn't look right. And again, if you approach the lows we've recently seen in the 110s, you don't want to do that again.
Yeah,
You
and
do, you're likely to get a panic situation in the debt market, government debt market.
yeah, I mean, the only way they could save the bond market would be to do massive QE, but that would destroy the dollar and it wouldn't mean
Well,
much.
maybe the dollar knows that. Maybe
Yeah,
that's why the
maybe that's
dollar
why.
is
Yeah,
breaking. Yeah, the
mm,
markets anticipate.
yeah,
You know, people wait for the news. Don't wait for the news. The news comes later.
yeah.
Okay.
So
Uh,
I guess I mean I'm holding on to my precious metals, my miners. I mean, unless there's world peace and government shrinks, government gets
well,
small.
you can
I
have the
can't
world
see.
peace, but it's the government shrinking is the big
Yeah,
issue. It
that's
always
the big
has
issue.
been.
Yeah,
It's not going to happen. And when you go into another recession or even worse, they're going to print, print, print like they've
mhm.
never done before.
That's
In
the only.
fact, the governor of the Boston Fed, a woman, I forget her name, about 2, 3 months ago at a press conference, about 1 week after after Powell had made this calming speech, at a Fed meeting a couple of months back. A week after that, she came out and made a statement that the Fed has several tools available to deal with any pending financial crisis. Why would she, yeah, there you go. Why would she make such a statement?
Yeah.
What's going on that would cause her to say we have several tools? So it's not just do we cut rates, but do we print, do we QEs? So that's what she implied, is that they know something's wrong, although she didn't admit it overtly. But why would she make a comment about we're ready to deal with something like this with multiple tools?
Yeah, that's strange.
It's
I
telling.
mean, their major tool, I guess, is creating more and more money out of thin air. Technically, it's reserves, but anyway,
M2 is exploding again.
yeah, yeah, it's making new highs, and
Yeah, yeah,
also in other countries like the Eurozone, which is run by the ECB, that's making new highs. Canada,
yeah,
Australia, I
yeah.
have looked at those charts. Yeah, and I think that's what's going on. Uh, well, Michael, thank you for your time. It's always great speaking with you, and I'm sure the viewers are going to enjoy this report.
The rest of the year should be fun.
Okay. Not that it wasn't fun the first 6 months.
Yeah, yeah, yeah.
Okay, great. Thank you. And
Thank you
have a
very much.
great weekend.
You too.